Hi, everyone. Welcome back to the For the Founders series provided by CBIC. Today we have Steve Keeler, partner at McGuireWoods, and Scott Zickefoose with Keiter CPAs, partner at Keiter CPAs. And they're going to help us today with session 5, talking about startup exits, beginning with the end in mind. So today, thank you, Steve. Thank you, Scott, for joining me today.
Hey guys.
And I know that startup exits is a very broad concept because there's so many different types and ways that you can exit. So Steve, maybe you could lead this off by telling us what are the different types of startups that startup exits that you see, and what are the most common that you see within the region?
Sure. So the challenge in talking about, first of all, thanks for having me today, Scott. Great to see you. I've worked with Scott on deals. The challenging thing about talking, particularly to entrepreneurs and early stage company founders about exits, is that you don't know when it's going to happen, right? Timing is everything. I recall in my career, early stage technology companies being surprised in their first 2 years of existence with a huge preemptive offer from a big company. Took them completely off guard. They were planning for a 3 to 5 year exit. I remember at the turn of the century, every company believed it was going to do an IPO in 6 months with no revenue or EBITDA. So you cannot predict the type of exit that you are going to do. When I say you today, I'm talking to you, the founder, you, the CEO, you, the startup company. So of course you cannot predict the timing. Why? You might be at an age where you're not ready to get out. The market may be good or bad. We may be beyond a presidential election. Your technology may become obsolete and you need to completely change your biz plan. So people get tired of hearing me say this, but my favorite quote from an unknown author, I think, is he or she who plans with a crystal ball ultimately eats glass. So for me, and I think Scott, because I've worked with him and he's a flexible advisor like you, Justin, you've got to plan with 4 or 5 different ends in mind and be very flexible. We've talked a lot in this series about choice of entity, key executive teams, your business plan, etc. So an exit might mean my client, you leave your company and your co-founder stays. It could be for very good reasons. An exit might mean a licensing arrangement with a major pharmaceutical who insists on licensing your technology, but they don't want to buy your company. That doesn't sound ideal, but I could mention a lot of people in Charlottesville who've done that either because the business was a kind of a disappointment, or they found that a licensing arrangement could be much more lucrative, especially if they were going to license technology to one player and maybe expand the business in another direction. So an exit, quote unquote, can be you leave the company, you do a strategic partnering deal, licensing deal, you hire Scott to do an auction or investment banking process. A preemptive strategic buyer calls you and says, we'd like to buy your company. By the way, in that instance, I think it's equally important to hire Justin as a lawyer and Scott as a financial advisor, even if you've only got one buyer, because we're going to talk about how the risks involved in this process, even if you're talking to one buyer. In fact, it might be riskier if you're talking to one large gorilla who loves you, they take you out to dinner, they want to buy your business. You don't want to be ambushed at the finish line. We'll talk a little bit about strategic versus financial. This is the point of your question, Justin. In my view, sales are probably 80 to 90% likely for startup companies, IPOs, 5 to 10% likelihood you'll go public on a good day. That's not all bad. I think most founders probably fare better in a strategic or financial buyer private equity fund exit. Choosing which one of those is best for your company is where Scott and people like him can come in. And the stock versus assets, which is kind of lawyer and CPA talk. It's sort of who cares? Let's see what it looks like. You know, the buyer's money is, if it's green enough, you're going to structure a transaction the way you want to structure it. So I'll end with, I see mostly strategic sales. If I represent you, the startup, I love equity sales. They're easier to close. We can usually get the buyer comfortable with successor liability. If you're an LLC or even an S Corp, the buyer can get comfortable from a tax perspective. But what I'll kind of end up with is, I talked about market timing, your technology, your business, your personal career. Each of these change, just like for the three of us and everybody on this meeting, each of these change every 3 months now. And what I want to leave the group with today, and Scott's all over this because it makes his job so much easier. Every decision you make about your company from this day forward shouldn't be driven by something you cannot predict, but you ought to think about it. If we do a bet the company contract with a major customer, could that impact the sale of our company? If I bring on 2 new executives and give them 10% of the company, could that impact the proceeds I get in a sale of my company? So when you make major decisions, focus on today, revenue, business growth, but always ask, how could this impact the sale of my company today or in the future? Not always an easy question to answer. And lastly, I'd encourage you to hire somebody like you, Justin, and or you, Scott, to meet every 6 months and just have sort of a, what if we sold the company discussion? You know, what do you mean? I told you I'm never going to sell my company, and we're certainly not going to. But why not have that discussion on a Saturday once a quarter or once a year at least? I think you might be amazed what you'll learn about what you're doing, what the market, et cetera, if you have strategic option exit discussions every year as you get there. Sorry to ramble.
No.
Yeah, so Steve, I completely agree with that. I also think like your discussion with the advisors, anytime you can get market feedback from people who are in your space and transacting and understanding what was valuable and what wasn't, and things that they tripped up on in growing their company, I think those are things that you can kind of take those lessons and apply them in your business going forward, so that if you're ever approached kind of unexpectedly, you've been thinking about that all along, you know, and you've been able to clear some of these roadblocks that people before you hit, because a lot of times we see things that are pretty easy to fix that people haven't thought about. And so if we can have those conversations early as you're building the business, I think you're better off in the long run, because you just don't know how it's going to exit. But there are just common threads, you know, and themes that are just good business practices across the board, whether it ends with a sale to a strategic or, you know, a financial buyer, these good business practices, and trying to be mindful of them all along.
So related to this, and to be perhaps a bit more specific, when we're talking about an actual exit, and perhaps it doesn't really matter so much depending on what the price is and what the after-tax results are, when startups and their founders are reviewing whether to exit in a certain form. Scott, can you just give a basic overview as far as what are the various tax consequences for, say, an asset sale versus an equity sale, maybe also like some sort of licensing IP sale?
Sure. So in our current tax structure, everyone tries to categorize as much of the proceeds as capital gains, because capital gains have preferential tax rates as compared to the ordinary income that we generate just from normal business operations. So at the core, we just try and take as much of the gain and make sure it's capital gains. One easy way to do that is to sell your stock. We think about that. It's like 100% of the proceeds, with few exceptions, would be capital gains if you sell your stock. When you sell your assets, you have to engage your advisors to make sure that as much as possible is capital gains, because there are many aspects in an asset sale that can be recharacterized as ordinary income. So generally, sellers approach, they love to sell their stock for a multitude of reasons, but you know, it preserves capital gains. buyers, for tax reasons, often like to buy assets. And then, as Steve mentioned earlier, for successor liability reasons, they sometimes default to an asset sale. And so there's a give and take there. People's interests are opposite each other in this. But at the core, we just try and get as much as capital gains as possible. We'll talk a little bit about it later, but there's also special provisions in the tax code to exclude gain. It's 1202 stock that we can utilize in specific situations. So that's another consideration in a stock sale, is if you are eligible for 1202, that might be a big incentive to stay in a stock sale if possible.
When you say asset sale, to circle back for a moment, and someone says you got to watch out for you have too many hot assets, what does that mean? Yeah,
so one of the best tax planning things that's available to small and growing companies is that they're able to report on a cash basis their tax as they grow. So what it allows you to do is only pay tax on the cash that you're receiving, and not, as your working capital grows, having to pay tax on that working capital before it's actually collected. And so it creates this category of assets which have value, but you haven't paid tax on them yet. You can think about that as like your accounts receivable is a really good example of that. And sometimes you'll see it with deferred revenue if you've collected cash in advance. But these are situations where you have an asset that has value, but you haven't paid tax on it yet. And so if there's an asset sale and you're a cash basis taxpayer, you might have these hot assets, as you say, Justin, where you have to recategorize some of your proceeds to ordinary income as if you had collected that accounts receivable that you just sold. And so there are ways that we work around that a little bit, but that's kind of an inevitable thing to have to deal with if you're a cash basis taxpayer.
What if you're a company that has a lot of inventory?
So if you have appreciated inventory that's above cost, so if you have some inventory that you've built that the buyer says is worth more than what your cost is in it, you would have that. You also see it if you've elected LIFO in accounting, so you have a LIFO reserve on your inventory. That LIFO reserve isn't reflective of the current economics of that inventory. So you'll have some ordinary income associated with that. And then you don't see it as much with startup companies, but also any amortization that you've taken on intangibles. So if you purchased a company and you've been amortizing the goodwill over the years, that amortization in an asset sale is also recaptured as ordinary income. So in a startup world, you might see that with 754 assets in a partnership or something like that. If somebody bought into a partnership, they might have this recategorization of income into ordinary income. So there are a couple different things that we look at in trying to see where the risks of recategorization is.
And of course, it makes the this whole analysis makes the allocation of the deal price to the company's assets pretty important. The seller's always going to want to allocate less to these recapture or hot assets, but it's really a recharacterization to ordinary income from capital gain of tax on these assets that you would have paid ordinary income tax on. So it's a recapture concept, but you can plan around it.
Steve, how do you see negotiations play out where a seller naturally wants to have an equity sale and the buyer naturally wants to have an asset purchase? How do you see that play out?
You know, I think I can comfortably say in most of the 2000s, we've been more, since the turn of the century, 20 years, we've been more successful with strategic buyers and with financial buyers, private equity firms, convincing the parties to do an equity sale if your company is relatively clean, meaning you've been good, organized, hired good lawyers and CPAs for the last 5 years. You've kept your house in order. You've protected your intellectual property. You haven't been sued frequently. So you have not been cheap about legal and accounting and frankly, technology consulting services. So we've been successful, and I've covered this in prior webinars, in the technology, SaaS, et cetera world. One of the best, the biggest, most compelling justifications for doing an equity deal and buying the whole company is that we don't have to go out to 50 to 100 customers and vendors to get their consent to an assignment of all their contracts. So a lot of our clients these days and a lot of platform companies in Charlottesville have 50, 60 SaaS clients with pretty standard SaaS agreements. If the client is a major client, you're probably going to give them a heads up anyway. But you don't want to have to go out to the whole world and get specific assets assigned. So as a practical matter, when I say practical, I mean non-legal and non-accounting. I mean real world. That's what I mean by equity deals being easier to close. Most strategic buyers and financial buyers who love your company can ultimately, they're going to say they're not willing to do an equity deal, or we're going to talk to our lawyers about it. It's going to take up time. They're going to try to scare you into agreeing to everything they want you to agree to. But it's an area where the parties can often agree that an equity deal is, they can get comfortable with it. If you're an LLC, again, it shouldn't matter to the buyer from a tax standpoint. The stakes are a lot higher if you're a C Corp, because selling assets will kill you from a tax standpoint. Buyers understand that. They're usually willing to work with you. So this is why people talk about MIPAs, Membership Interest Purchase Agreement, EPAs, Equity Purchase Agreements, and SPAs, Stock Purchase Agreements, these days more often than APA, Asset Purchase Agreements. Fewer deals have to be done as asset purchase deals, although Scott and I, we work on a bunch of both. So love equity sales, easier on the lawyers, easier on the accountants usually, and we ought to be able to find a way to make them feel and act like an asset purchase. And by the way, buyers are going to assume a lot of liability as a practical matter in asset purchases anyway, so I think that's overrated paranoia. That's successor liability analysis. So hope that answered your question.
Yeah, Steve, I was just going to add to that like you were saying with the if you have a partnership, you know, you can get effectively an asset sale even with the membership purchase agreement. And you also see sometimes if for some reason you're set up as an S corporation, you know, some buyers will ask you to go through an F reorg or something that restructures you prior to the sale. So the way I always think about it is from a legal standpoint, like with contracts and that kind of stuff, and from a tax standpoint, what are the desires? And there's so many tools that your accountants and lawyers can use to structure a transaction.
Yep.
To kind of get you what you need from those two perspectives. So there's a lot of flexibility as a result of you know, 338 H10s and F reorgs and these different things that have kind of developed.
By the way, two other, I think, pretty practical things. One, a lot of people talk about merging their companies into Microsoft or a big company and getting stock in the acquirer. So one thing that hasn't changed much for decades is that you can sell your company to a big co, and if half the deal, roughly, it can be less or more, is stock and half is cash, you can get tax-free or tax-deferred treatment on that tax on the stock that you receive in the big company. Scott and I are most often going to advise clients not to. It better be a great deal if you're going to take that much of a public company stock, because we know horror stories where people have sold their companies to a large company when the company was trading at $15 and then it went to $2 before they were legally allowed to sell the stock. So we like our clients to diversify their net worth and go to the beach and have a great life. Telling you better get a lot of cash in a deal for stock doesn't mean that you wouldn't want to take Apple stock in the right deal. That's number one. And two, understand again that when you're having that conversation about tax planning, the buyer might want you to stay on and keep some of your stock or roll over. They might say, we're going to buy you out. We want you to stay in for 10%. We need you for 3 years. A lot easier to do that if it's an equity sale.
And not to confuse this a little more, but Scott, is it possible, or are there any tax provisions that allow legal equity sales to be treated for tax purposes as asset sales and vice versa?
Yeah, so the 338H10 and there's a 336E, those are two different code sections that will be referenced, but will allow you to acquire stock legally, but have a deemed asset sale for tax purposes. So that's what I was saying, you look at the objectives of the parties, and usually you can come up with whatever the appropriate structure is, or a negotiated structure. We talked a little bit about the give and the take of seller and buyer's interest when it comes to allocation of purchase price. So one way of negotiating that is sometimes an allocation that's unfavorable to the seller is very valuable to the buyer, much more so than the detriment that's caused to the seller. So sometimes we'll see a gross up or some kicker put onto the purchase price to compensate the seller for an unfavorable attribute, because the buyer says, well, I will get $1 million of benefit and it only cost you $100,000. So I'll pay you $105,000 so that I can get my $1 million of benefit. And so that's just another way that we can kind of structure together something that meets everyone's needs once you understand what everyone's objectives are.
And by the way, more common, I think, in the startup world than 338 or 336, because most of our clients are not going to be S corps if they've been raising capital from rich people and family offices, is an LLC sale. If you sell your membership interest or shares in an LLC, it's awesome. It's a equity sale for legal purposes, but the buyer can make the 754 election and in a stepped up basis. It's treated automatically as an asset sale.
Right.
Or purchase for tax purposes. That's awesome.
Scott, can you touch on 1202 gain exclusion?
Yeah, so for a while now, with original issued stock in a corporation, there's been the ability to exclude a portion of the gain in a sale of that stock if you meet certain requirements. So we won't go into the requirements, but the key there is that it's original issued stock is usually the first tripwire that gets people to not be able to get 1202. The amount of gain that's excluded has kind of varied over the years based on when you receive the stock and what year you sell it. That number fluctuates as high as 100% up to a certain amount. We were talking before we got on here that concept is very appealing to folks. They say, oh man, I can start a company, I can run it, and I'll sell the stock at the end and I won't pay any tax, which is like the very oversimplified version of the story. But as a practical matter, as Steve has talked about a couple times today, you just don't know where you're going to end. And so if you're going to be a corporation anyway, for other reasons, it makes perfect sense to try and make sure you're set up and thinking about preserving 1202 options for later. But it seems a little foolish to plan for an exit of 1202 to exclude gain because, we mentioned it from the tax perspective. An asset sale within a corporation is brutal. And so if you are a corporation solely because you want to sell your stock and get 1202 exclusion, and you find out for one reason or another that they will only buy your assets, you just were heavily penalized for something. So, you know, it's something to be aware of, but it's probably not something that we want to plan and execute our whole business around trying to get 1202 stock exclusion.
Do you know offhand, just so the viewers can understand the potential savings? It's millions, right? It's not thousands that you're potentially able to save.
Right.
Right.
And like I said, I haven't looked at it recently, but the threshold and the exclusion percentage change over time depending on when you got the original issue stock in the year in which you're selling it.
Right.
But yeah, it can be a very meaningful exclusion that's available to you, and a huge incentive to sell your stock if you can. You know, if that's an option when you exit.
Cool. So turning a bit here, Steve, maybe can you help us understand the process once you paper an MIPA, APA, SPA, whatever the form of the deal is, what happens from there to the inbound wire to your checking account?
Sure. So before Scott and I talk a little bit about that gauntlet, that process where you get a contract signed and you race to closing. The mistakes are made much earlier than that. So we'll back up 3 months, let's call it, to the letter of intent or term sheet. So I was thinking about sort of tips for the seller. Today, the three of us talked a little bit about the theme today. And if you're an entrepreneur and you've got an early stage company and you may not be exiting for 3 to 5 years, you don't need to memorize what we're going to say about selling your business, because hopefully you're going to come to Justin and Scott a year from now if that becomes a reality. So what I, of course, wanted you to focus on is as you do things, ask your advisors, will this have any impact on my sales price or term someday, or the attractiveness of my company as you make big decisions? So the process is really about, most of the people on this Zoom meeting have probably been to seminars and understand this. Process is usually about courting multiple buyers and or getting call from one buyer and moving the process that Scott might run to a term sheet or a letter of intent with one buyer. A buyer is typically, if they're smart, is typically going to ask for a letter of intent and demand it because they want to take you off the market for 90 days, if not 6 months. Don't ever do it for 6 months, Scott will tell you. But if you're a great business, Scott might successfully negotiate a 30-day lockup or no shop. So buyers will say, we're not going to pay Steve Keeler a fortune to represent us against Justin in buying your company if you're talking to other people, right? We want a commitment. We don't want you to date around while we're doing our due diligence, our quality of earnings report. So the letter of intent, the lesson there is you, the seller, lose a lot of leverage the day you sign a letter of intent. Not because the process won't continue to be confidential, not because you cannot get out of the LOI, you probably can. But when you sign an LOI, the process, the leverage really goes to the buyer because you have to tell your CFO, your HR person that we've got a process started. You have to start, in addition to your day job, doing a lot of work on a deal, right? So what that means is that a letter of intent, more is more. A letter of intent should be sufficiently detailed and cover the details about purchase price adjustments, earnouts, whether you're going to stay for a while. Detail matters if you're a seller. So with apologies, just wanted to mention that letters of intent, if taken lightly, can really create problems and cause an ambush at the finish line if you sign them without counsel.
Yeah,
So,
and Steve, I would add to that. Our clients all the time come to us with a signed letter of intent.
Yeah.
And you look at it and you say, these are very simple things that we could have gotten different, that letter of intent, I think in the M&A world, being told that you retraded something is like one of the biggest insults. And
Yeah.
what you have is everyone compares back in the process back to that letter of intent and said, well, you already agreed to this. We can't negotiate this. You already agreed to it. And like you were saying, you lose a lot of leverage once it's signed. That letter of intent represents the high water mark for what you're going to get for your business. Price almost always stays or goes down. Rarely do you see price go up after a letter of intent. So you need to make sure that you're very comfortable with the terms that are in there, because it's a gauntlet, and you're defending that value for the whole process till you close.
Right. So don't sign an LOI without review by all of your advisors. Oftentimes when I get an LOI, if it's not signed, Scott's firm will have already been doing financial due diligence on the part of a buyer. So buyers typically do due diligence on your business and the financials. The lawyers can often get involved later, maybe even too late, but beware of no shop and exclusivity or breakup provisions. And an LOI can be binding if you're not careful. So talk to Justin and me about how to make sure it's not totally binding if you want to be able to get out. So back to Justin's good question, this will go more quickly, because I do think the LOI is more important even than a definitive agreement in some ways, because to Scott's good point, you really lose that leverage in the high watermark. Pick the right buyer. The right buyer is not always the buyer with the highest price. Assign tasks. If you sign an LOI, to Justin as your counsel, to Scott and his firm as the financial and accounting advisors, to your own team. Who's going to do what in responding to the buyer's request? The buyers are going to give you a 20-page due diligence request list that's going to tick you off. And it's going to make your COO miserable, or you, the CEO, if you're doing everything. So be ready for it. Don't get mad. Don't get emotional. Buyers, especially in the current market, are going to do a lot of due diligence. And one of the biggest things, and then I'll kind of move to cut and dry, the biggest difference between the current process of selling your company today and 4 years ago even, is the paranoia on the part of buyers that they're going to buy a data security problem, an open source software problem, or another technology or intellectual property related issue that they will inherit, and it will embarrass their company if they find out a month after closing that your email was hacked a month before closing. So what Scott and I found is that in the old days, real estate and employment agreements took up a lot of our time. Immigration, do you have all of your I-9s? Today, it feels like a third to a half of the due diligence process is around the buyer's review of your Microsoft agreements, your partner agreements, the adequacy of your internal controls, your protection of your intellectual property and your data security. And that's about taking credit card payments from customers. If you're in the healthcare arena, you could have healthcare information. So that's a huge area, and private equity fund buyers and large strategics are scared to death to buy a minnow. They're the whale, and the minnow ends up having a whale-size, embarrassing problem with credit card information hacking, those sorts of things. And Scott can tell a lot more stories.
Anytime you have personally identifiable information, it's a ton of diligence around that. So credit cards and any like patient healthcare information, anything that's that PII, you'll definitely have diligence done around that.
So a typical arrangement is, depending on whether you're shopping the company, if you shop the company, you get 3 to 5 bids. You pick one bid. Scott and their firm, they're invaluable. I used to be jealous because they get paid a lot better than I do, but they get commissions. I cannot overemphasize the value of having a financial advisor, investment banker on a deal to help negotiate the process of selecting a buyer. And then after you select the buyer, Scott's team can keep the lawyers honest about information exchange. There's always some bad news about missing your earnings, or we found something in our due diligence. So the process, you pick a buyer, you agree to sign a contract either at closing or within 30 days, and you close 60 days after. Be patient and ready for the buyer's due diligence. It's frustrating, it keeps you up at night, but keep your eye on the prize. Don't take it personally, don't be frustrated. Keep the buyer on a short calendar. Don't let them keep your company off the market for 8 months. And show them quiet confidence. Tell them you're not going to wait around for 90 days to sell your company. If they want to buy it, you expect to get their attention and to run a good process. Be deadly honest and transparent. Whenever a client asks me, Steve, should we tell the buyer this? I say, of course you should. Let's talk to Scott about how we can message it to the buyer in the right way. But as soon as you can tell a buyer about a problem, the greater their trust level is going to be increased. You will kill a deal in 2 ways. Missing your earnings and telling them about it, your earnings projections, and telling them about it 2 weeks before closing, or waiting 2 months to tell them about a sexual harassment lawsuit. Buyers are big boys and girls. They don't care about your problems. I've said this in raising capital. The more bad news you give a buyer or investor, the more comfortable they are. All they want to know is, how are we going to deal with it?
Yeah, Steve, I can't tell you how many times a seller has said they'll never find out X, and the buyer almost always, either themselves or someone on their advisory team, always finds out X. So it's whatever it is that you are not comfortable disclosing, they've got a team of sophisticated people on the other side whose task is to find out that risk or whatever. So I completely agree with you. Transparency and messaging early is important, and it goes a long way in building that trust in the process.
And hopefully you've done reverse due diligence on your company before you start the process. You want to find the hair on your deal or the problems in your company, the dead bodies behind the walls, before somebody else does, because you can make a good presentation. So Justin, the lawyers then are tasked with negotiating what these days is a very standard form agreement. They're all pretty long. I think you should be prepared for a 35 to 55 page definitive agreement. Seems like overkill, but just the way it is. There's a lot of reps and warranties. The promises you're telling about your company. You're not going to go to jail if you're wrong about any of those promises. You're just going to have escrows and indemnification, maybe insurance to protect the buyer against things that you didn't know about. So, the big part of our job as counsel is to mitigate the seller's post-closing exposure to claims by the buyer. Buyer comes back and they want their money back. They want to hold back earn-out payments. The way we do that is, to Scott's point, we encourage you to be honest, disclose everything, so that when the buyer comes back and says, we're not happy with what we bought, you need to clean this up. We say, we told you about it, and you knew about it, was on the disclosure schedule. So that's an important part of the process. We negotiate reps and warranties and indemnification, the ability of a buyer to come back and sue you if they think they pay too much for your company. It's not personal, it's business. And what we do as lawyers, 80% of the process of negotiating the purchase agreement, if Scott and others and you, the entrepreneur, spend some real time on the LOI and talked about the purchase price and the adjustments and the earnouts, if the business deal is as solid and clear as it should have been, right, early, the lawyers won't get away with renegotiating the business deal. All we should be left to do is to make sure the reps and warranties are reasonable and that the seller is not exposed to risk for 5 years, right?
Yeah.
You should only be exposed for 18 months or until the first audit. I'll leave you with this, and probably didn't answer the question, but it's just such an amazingly human and dynamic process. You can see I get excited about it. We minimize the post-closing risk through negotiation of fair reps and warranties. Earnouts and price adjustments, I'll throw it back over to you guys. If you don't get those right in the letter of intent and the definitive agreement, it's going to be a cluster, because the seller always loses if you get those wrong, because guess what? The buyer has the money.
Yeah.
The buyer's not going to pay you any post-closing payments if they're unhappy. So make sure you minimize the earnouts, purchase price adjustments, stick them in an escrow where they're safe. But if you're relying on the buyer to make future payments under a note or an earnout structure, and Scott and I don't understand the legal language and the earnout of the purchase price adjustments, you're never going to see that money.
Yeah. Yeah, and I know we're nearing the end of our time, Justin. The only thing I would add to this is seller fatigue is a real thing. And when Steve was talking about delegation, it might seem like you're spending a lot of money to bring in advisors and help, but your time is going to be incredibly valuable during that. You have to continue to run the business and make sure you don't have to deliver that earnings conversation where you missed earnings because you took the eye off of your business. So you've got to do that and manage this very lengthy process. So go into it knowing it's a marathon, but be comfortable bringing in advisors, because anything they can take off your plate, they know what they're looking for, and they can help you get to the end and not be so stressed out. So I think sellers really underestimate the demands on their time during this and don't understand why buyers are so have such scrutiny over everything. So go into it knowing you're definitely going to be tired at the end.
But it's worth it.
It is. It is.
Yes. Yes.
Totally.
So one last piece, Steve, could you, and you've touched on it, you've both actually touched on it a bit. Can you elaborate on purchase price adjustments and the earnouts? What are you typically seeing? Is there certain things that are market for some startup sales versus others? What are you seeing there?
Yes, Scott's going to do a better job with this, but I see typically there's at least a working capital post-closing audit of your business where we agree that when we close, your working capital, which is cash and receivables less your payables, is zero, right? If you're running on a shoestring. And then if 30 days after the closing, Keiter does an audit, and the buyer finds out that if they're working for the buyer, let's say, Scott,
Yep.
and the buyer finds out that you were really 50 grand in the hole because you overstated your receivables, not that you were dishonest, but it was just kind of murky, they might want to hold back 50 grand of the purchase price, pay you less. So most businesses are valued either on the revenue or an EBITDA profit times a multiple type of structure. And it's kind of interesting to me because that's usually such a big number. It's silly in a world where companies run with so little working capital that the purchase price is really about, we think you're worth $15 million or $5 million. This assumes working capital of 50 grand. That's what we need every month to run the business, or this assumes zero working capital. If the targeted working capital ends up being wrong or not what the buyer expected, because you've got to do a post-closing true up, right? Because you're collecting stuff. There's usually a very simple 30 to 90-day process to do what's usually an immaterial adjustment to the purchase price. You might even hold back some of the closing price, put it in escrow. A lot of deals have more substantial purchase price adjustments driven by surprises in debt, deferred revenue, huge accounting item for technology companies that we'll leave for another day. I'll leave to Scott. On the earnout front, Justin has talked in the past, and I think he's done things outside of the series on revenue based capital raising agreements. If you're going to do an earnout, essentially what it means is we can't agree on price. We'll pay you $1 million at closing, and we're going to pay you $1 or $2 million over a 1 to 2 year period if you deliver, if you perform as a company. You think you're worth $3 million, we think you're worth $1 million. The earnout is usually driven by one or more economic milestones, performance milestones or bogeys, like you've got to achieve EBITDA of X in the first 12 months after closing, or a growth factor in revenue of 15% post-closing, or both, or any number of other economic drivers. Some deals, by the way, if you're a seller, you'd rather have just seller financing or a seller note that says, we're going to get extra payments after closing, but they're not contingent. We just get them 6 months and a year and a half. That's what I call a seller note or seller financing. It's post-closing, but it's not contingent. It's kind of risky, but in an earnout, it's contingent upon performance. It might be contingent upon getting FDA approval, getting a federal agency to approve your software for a particular application in government contracting arena. So I'll leave it at that and say, you can imagine it's like a licensing agreement with a royalty. If you don't get the accounting and legal terminology, the calendar, the definitions of what profit is, what FDA approval means, if you don't get those right, you're going to have a hard time getting the money. So what I see, again, are working capital adjustments on purchase price. I'll leave you with this, because this is what makes Justin's question so great. In my experience, purchase price adjustment and earn-out disputes are much more common than lawsuits about breaches of reps and warranties and big problems, indemnification claims. So get them right.
Yeah, details matter. Right. Yeah, details matter, and it really you've got to really rely on your professionals here to collaborate with you, because there's a lot of stuff that's unseen. You're not thinking about what could be. And I mean, Steve, you and I were talking about a pandemic. Like, no one expected a pandemic to hit. And so when we're thinking through these, we need to talk with seller and buyer and say, how do we want to think about this? What happens if X happens? And we always like to see, on a seller side, that earnout as high up on the income statement as possible, because it's the least amount of manipulation that a buyer can have on it. So we want to think about, once the financials and the business are in the control of the buyer, what are ways that they could manipulate or change things to disadvantage us? And when we work for you as a seller, we try and protect the seller against those things. So
revenue, gross profit, earnings. You
right.
want revenue if you can get it, gross profit if you can get it. Earnings are more manipulative, so that's right. Riskier for a seller.
Right.
Yeah.
Well, thank you guys, and that wraps up our time. This was very informative and insightful. Thank you both. That'll conclude session 5 of this pre-recorded content. We'd again like to thank some of our sponsors for this series, and we hope that you can join us for our live component of session 5 on October 13th.